Hi, I'm Jim Kniffin, certified financial planner and fiduciary investment advisor. Each week, I walk you through the markets the way real investors should see it. No noise, no predictions, just trends, leadership, and risk management signals that actually matter for compounding your wealth. My goal is simple: to give you clarity, confidence, and a practical roadmap so you can stay on the right side of the market and avoid the big portfolio killers. Let's jump into the charts. The NASDAQ 100 continues to lead the market and gave us a nice surge last week, as did the Russell 2000 small caps. The S&P 500 performing quite nicely, up near all-time highs, and the Dow Jones Industrial Average brings up the rear, still performing quite nicely though. Looking at the moving averages, the S&P 500 is back above its 21-day and 50-day moving averages. Most would consider that a bullish sign. Looking at the daily volatility on the S&P 500, again with those moving averages behind it, we can see those two really nasty days a couple of weeks ago and then a couple of months ago. But the market seems to have recovered from that and is pressing on near all-time highs once again. Looking at stocks versus bonds, while bonds have an important role in a portfolio, providing stability and a cash reserve for shorter-term needs, the S&P 500 performance has continued to dominate. Looking at corporate bonds, the yields are a little bit better. The performance has been a little bit better than the government bonds. And looking at my favorite chart in the whole deck, the U.S. large cap growth, once again surging and outperforming U.S. large cap values. Still a great place to be invested. It's been a good year, but large cap value underperforming just a bit, a little easier to hold. So it still has a place in a lot of portfolios. Small cap indexes outperform the S&P 500 just a little bit, and microcaps are really surging once again. Looking at high volatility stocks performing well versus low volatility stocks, abysmal. Dividend stocks giving a nice return, but kind of flat for the last 3 or 4 months and lagging the S&P 500. It's great to see technology surging once again after that nasty pullback in November. Healthcare is taking a little break from its recent uptrend. We'll see what develops there. And let's take a look at consumer discretionary compared to consumer staples. What a difference. The discretionary outperforming staples by that much, most people would consider that a bullish sign. And then when we look at the laggard part of the market, the financials, materials, energy, and real estate, we really don't see much leadership there. Thanks for investing a few minutes with me today. My goal is always the same, to help you see the markets more clearly and make steady, confident decisions. If this was helpful, please feel free to share it with a friend. And if you have any questions, just reach out. I'd be delighted to talk with you. Remember, stay disciplined, stay focused, and keep on compounding.